Hello there. This is Terry Bell here from Bell & Company. This is a podcast that we're running where we're talking to what we see as people that are in the know in terms of the amount of BS that's out in the world, and also doers in industry, restaurateurs, retailers and the like. And it's my great pleasure today to have with us Russ Mould, who is I think your title is the Research Investment Director at AJ Bell.
Yeah, just investment director now, because it was originally research investment director, and I pointed out that spelled RID, which meant that AJ Bell could get, which I didn't really fancy, so we went for something a bit shorter.
On it, so too many acronyms in the world, don't you? Very careful. You're a star of TV and radio. David Buick has advised me.
Oh, well, David is a good judge, and I found that very flattering, therefore. Yeah, but that's for him to say, not me.
I called him a city grandee, and he didn't like that.
No, he won't do.
No, he didn't do either. But anyway, David Buick, who's also often on TV quite a bit, he recommended. So when we finish here, just so you know, Russ, we'll be asking for a couple of recommendations who we should contact, if that's okay.
Yeah, that's fine.
And David basically threw you under the bus. So
that's okay. I'll get him back when I next see him in Sweeties, which hopefully we can visit soon. You never know.
Absolutely. And I tell you what, with David, just before we go on, I love the way he carries on Twitter, David. Just takes it to the edge, trying not to fall out with folk, but just making sure people understand what his opinion is.
Yeah, that's one bear pit I generally try and gently teeter around the edges of and try not to get too heavily involved.
I questioned something that Austin Healey had said, and I've only got 11 followers. I'm nothing on Twitter, but jeepers was there a pile on. It's a
spooky world out there. But yeah, people will say things to you that they wouldn't necessarily say to you in person. So I find that quite hard sometimes.
Yeah, very much so. Very much so. So you as a person then, Russ, you're with a couple of bits we picked up on you're a part share owner in Lewes Football Club?
That is correct. You're only allowed one share. So I've got no great claims to anything here. It's a publicly owned club. You buy one share, you get your one vote at the AGM, and they did a crowdfunding last year to raise money for their new floodlights, because the previous ones had been paid for by a Pink Floyd concert in the 1960s. So They needed some new floodlights to meet FA requirements. And they raised about £34,000, which then grants doubled up to get them to the money that they wanted. So I love it. I'm a kind of bizarrely slightly lapsed Leeds United fan after a very fallow length period.
Oh, Jesus.
Of fortunes. Also living in Brighton and getting up to Leeds, it's just not very convenient anyway.
Yeah.
And I've just found non-league football to be enormous fun when we're allowed to go, of course.
Right. I'm a rugby man. We'll come back to that in a minute, because obviously AJ Bell was linked to Sale particularly. Then the other things we found out about you, and you're a lapsed as well, I hear now, as a lover of the horses, but obviously we can't attend, so that's...
Yeah, love the horses still very, very much. I don't know whether you can see the office behind me. There's loads and loads of equine books down there. Love thoroughbred horse racing, but because I can't go, I'm generally really only bet when I can go. Yeah. And that's part of the discipline, so I don't get involved in a tap thing, which I think, in the end is what the bookies want. And I always remember Cyril Stein, when he was introduced to Ladbrokes by, I think, his uncle Snouty Parker. They went to a bookmaker's in North London, and Stein noticed there were 3 kiosks saying bet here and 1 kiosk saying pay out.
Absolutely.
And he thought, well, this is a good business. And I take that on board. So I do like to think I'm a disciplined punter. So I try and stick to it when I've done my study and my research properly, and when I'm at the tracks. I've not got involved since the lockdown. Basically.
Since the lockdown, yeah. And then your other vices, because we're only dealing vices in terms of what you have there, fine food and craft beer.
Craft beer, I'm very keen on.
As a Yorkshireman,
very blessed. Yeah,
that fancy carry on.
Yeah, no, but I've got lots of Timothy Taylor landlord in the house at the moment.
Good man.
Keithley's finest. But Sussex, there's a thriving scheme. One of the lads who's on the committee at the local cricket club where I help, he runs an off license here, and Toby's got a fantastic selection in the shop. So I'm busily working my way through those.
It's God's own nectar, is landlord, isn't it? Taylor's landlord.
It's just unbelievable.
But it's also, I don't know if you know this, it's Maradona's favourite beer. It was Maradona's favourite beer, apparently. Yeah, absolutely.
Really?
Absolutely. A weird fact. He put it up there.
Very strange.
Yeah. Right.
So I have cultivated a taste for Harvey's, which is the local Sussex.
I was going to say that as well. That was the other thing.
It's just round the ground from the Lewes Football Club. The brewery's right around the corner from
I was going to say
Rooks.
When you've got that there, and what have we got? King and Barnes down that neck of the woods. Is that still?
Yeah, I think so. Don't see so much of that around, but certainly plenty of Harvey's and plenty of craft beers, which keeps me more. And hopefully, my lovely local pub is reopening on the 17th of May. He hasn't got a big garden. Steve and Vicky, the landlord and landlady. So hopefully the 17th of May.
Claim the street.
Fingers crossed.
Absolutely, very good. So anyway, that's the economy in one: beer, horses, and
horses,
and sport. That's good.
New floodlights. Yeah, exactly.
It's very good. So AJ Bell, so you're the investment director, sorry, now
yes.
at AJ Bell. Give us this is your chance to plug AJ Bell. So we've our research says there's about 62 billion under management.
Spot on. Your researchers have absolutely nailed it. Yes. So we're what's known as a platform. I mean, when I'm on radio and telly, we say stockbroker because it's easier for people to understand. But that we basically administer people's investments and make investing easy for them.
Right.
So all of their funds and shares are all in one place. We now offer cash management services. We help them with their tax reporting, and we try and make it so you can do it over your laptop, your mobile, or wherever you are, and we try and make it as cost effective as we can as well. So we help out hundreds of thousands of investors, private investors, and also financial advisors use our platform as well to help their clients. So it's all about making things as quick and simple as we can, while obviously making sure people's money is kept safe and secure.
Mm-hmm. And in these days, that's going to be more and more important, I think, as we go forward here.
We spend a lot of money on IT security to make sure that our customers harder and £62 billion very well looked after. Yes,
absolutely. And so just recently, and it's definitely not a link, but the FCA was slightly concerned the other day about young people and the way their investment trends are. And when can you give us a little bit of a heads up on how you look at that, because it's back to the click potentially.
Yeah, no, it is. And it's something that we're monitoring very, very carefully. We don't provide advice, but we do provide context and background and information for people to help them make the best decisions that are most suited to their circumstances. So we will try and say, these are the things that you need to think about. What's your long-term strategy? What's your time horizon? What are you actually trying to earn each year? And what's your appetite for risk, which is best defined as your willingness and ability to lose money when you're trying to make it. And what we are definitely seeing is our customer base is getting younger.
Yeah,
we're getting more and more young investors coming along. The average age is, I think, 43 now. Well, that's dribbling down, but we're seeing a lot of customers in their 20s and 30s signing up now. Again, because they can do it over their mobile phone, and therefore we've got to be absolutely. Although we call ourselves a stockbroker, in some way we're probably a technology company more than anything else. And we are looking at that, and we are therefore trying to help them as best we can without giving direct advice, because we have seen a lot of activity in names like GameStop, for example, particularly amongst the younger investors.
Yeah,
I think we saw, I think it was something like 1 in 2 investors under 30 were having a bash at it, and 92% of those customers were men. Which read into that what you will.
Yeah.
So we are aware of that, and we are aware of our responsibilities to make sure that people hopefully help them avoid some of the traps and mistakes that you can make if you're an experienced investor. Because generally speaking, we've had effectively a 12-year bull run. I know we had a bit of a wobble last year, and there've been stumbles in 11, 15, 18, but generally speaking, the chart's gone from the bottom left to the top right. And stock markets are at their most dangerous when making money looks easiest, which in some ways it does look easy at the minute.
And it's trying to keep it out of that sort of, go back to the demographic, we call it the 92% young men thing. It's almost like keeping it out of that gaming field. That thing when you've got Reddit and GameStore and then social media, it almost comes not a perfect, but an ugly storm. True. Not a perfect, so it's an ugly storm, and it can suddenly get a little bit out of hand, can't it?
I don't want to. I mean, I'm nearly 52. I don't want to go around sounding like people's dad or even granddad. And again, we don't give them advice. But this is the sort of thing I've seen before in 2000 and 2007 in my career. And behind me, there's loads and loads of history books that tell me this has been happening since the 1690s.
Yeah.
So although technology changes, human behaviour doesn't, and I think that's one thing that we all need to be very, very aware of. And I'm thankfully not at the stage where loads and loads of friends are coming to ask me for tips, but then they've probably given up because I never give them any. I just say, look, I'm an authorised and regulated financial advisor. You've got to be careful. And B, tips are for waiters, rubbish dumps, and Deliveroo riders. So
very good.
You've got to be pretty careful there. So do your own research is the one thing that we really, really preach. Because
and
if you don't understand something, you're guessing. If you're guessing, you're gambling, and then it's back to the 3 kiosks say pay here and 1 says pay out.
Exactly. And it's putting in those sort of not controls, like you say, but it's making sure. But is that really your level of risk you want? Are you sure? Do you understand the ramifications?
Correct. And that's absolutely, because in the end, and risk in an investment sense is losing your money. Now, we've talked about gambling, and it's very, very different from investing in that you can do all your research as I do on the ponies, but the jockey can make a mistake, the jockey can fall off, the going can change, the horse can be badly drawn, and your return, if something goes wrong, is zero because you've lost your money. Whereas with investing, the first thing to do is focus on downside protection, because even if something unexpected happens, like a pandemic, you've got a company that has got hopefully a good balance sheet, can withstand the bad times, and you can be patient and see you through. And I think what we stock markets, financial markets, when they work well, are get rich slow mechanisms. They're not fruit machines where you just pull a handle and hope for the best. And I think that's something that we do try and get across in customer webinars and seminars and the pieces that we put out to our customers and clients.
And sounding like an old man, and I think because I'm older.
Sorry,
I'm even older than you. No, but it's that thing where everything is quite sort of self-gratifying quite quickly in the world, and then it going back to investments, making sure, guys, it's almost like saying in the old school stuff. This is bottom drawer stuff. Put that away. If you got money to play with it, but get your mix almost right.
I think that's right. I mean, I'm not averse to customers having, for want of a better turn of phrase, a sort of portion of their portfolio that's sex, drugs, and rock and roll. Yeah. Where things can be really exciting and can go up a lot. But and if they double or treble, they will make a difference. Yeah. But equally, that percentage of your portfolio won't really hurt you if it halves or goes to zero. And I think that's really what you're trying to achieve. So one of the things that we always say is, look, the AIM market, the junior market in London, the small caps. Not always, but generally small caps, is about 3 or 4% of London's market cap. Yeah. It attracts a huge amount of attention relative to that, certainly amongst retail investors, because they're looking for that next big thing. Yeah. But if you've got the shares portion of your portfolio and you've got more than 3 or 4% in AIM shares, whether you know it or not, you are taking on above average levels of risk. Mm-hmm. You've got to know you're doing it, and you've got to be comfortable with that. And if you're not comfortable with it, then that's maybe when you need to think about what you're doing a little bit. Yeah.
And you say, and because COVID, terrible thing that it's been, especially on the death side, it's the ultimate, it's reset, isn't it? This is what can happen, guys. Our opinion was always the economy's, excuse my parlance, it's spluttering and farting along. It wasn't going anywhere great. It's fairly okay. And something was due, but to throw a pandemic in that actually gripped us like it did.
Yeah, completely unforecastable, and in the end, share prices are a bit of irrelevance compared to the loved ones that people have lost and the health woes that people have suffered. But looking at it from the narrow perspective of share prices, it was a huge shock. But equally, you read work, but I think it was the American economist Morgan Housel wrote, when you read the history books, and I've read loads and a lot of them are behind because I did history at university. You read the history books, it's not what's in the history books. It's not Russ Mould got up, went to work 5 days a week, got on the train was vaguely on time, it was a little bit late, and he went down the pub. The stuff that's in the history books is, oh my goodness, there was an earthquake, there was a war, there was a pandemic. It's the sort of tail ends of the bell curve, as it were. It's the extremes at the end that make the history books. And that, as an investor, is probably what you always need to have in the back of your mind, is that something is going to come along. Now, it might be every 5, 10, 15, although in terms of stock market volatility, they've been getting more and more frequent and getting bigger. Mm-hmm. And I think that's because the foundations are weaker, because there's just more debt in the system, and central banks have tried to keep the plate spinning, but they've done that by making debt cheap and encouraging people to borrow more. So you're trying to cure a debt crisis by encouraging more borrowing, which is not a long-term solution. And it means that the foundations are more fragile and are more prone to shock when something, again, I think when people are building their portfolio, that's something that they need to be aware of. That, again, it sounds boring, but investing is ultimately kind of supposed to be boring, because it's about setting out for the future. Roller coasters are exciting, but you don't end up with anything left at the end apart from a beating heart and an empty pocket. And you don't want investing to be like that. So it is about finding companies that good competitive position, strong profit margins, good cash flow, can pay dividends, and have finance so they can withstand some pretty bad stuff. Because it's the ones that can't do that are the ones that get trouble when trouble turns up, which it will. As Tim Price was writing in his blog the other week, he was quoting No Men from Old Country. The sheriff says, well, if this isn't a mess, it'll do until one comes along. And at some stage, one will.
Yeah, there were two things. There was a guy who used to go to our rugby club. He was the chairman of Skipton Building Society, John Goodfellow, back in the day. Great Glaswegian, bit fresh with the language, but very good. But he explained to me the 2008 crash, and he said that's because the world became full of wooden dollars. Tokyo, London, New York, Tokyo, London, New York. Said, and it went wrong because some bugger had the temerity to ask for their money back.
That's the thing, and and you're seeing that now with Archegos, this hedge fund that's gone under this week. The banks, somebody somewhere got cold feet, decided they want their money back.
Absolutely.
And that's when and the thing is, you never know when that's going to be that person decides enough's enough, but they will eventually.
That's coming. It's a little bit like the Suez thing this week, the boat getting stuck. You've got a major transport channel. And it's really, I was speaking to a guy who's actually a solicitor involved in it. He said, it's a really great trench. You couldn't actually get to it. So you had that image of the wee digger, because that was the only thing that could get there to start with until this happened. That's because we live in the world on that just-in-time delivery of stuff.
Yeah, it'd be interesting to see if that changes. Given that whether you believe in it or not, and I'm trying to stay as neutral on it as I can, looking into it through share prices, whether you're a believer or not in Brexit, it is it is potentially a deal that is designed to sort of restrict trade flows to some degree, or at least tilt them in a different direction. You've now got companies looking at supply chains because of the pandemic. You've got trade tensions between America and China, and Europe and China. And so I think you are seeing a world where people might just try and run things that are a little bit less keenly, a little bit less tightly than they have. The FT called it a year ago, saying that we'd swapped robustness for efficiency, for timeliness. And I think with the phrase that it used, and I think that's pretty good. And I think you will see managers you would like to think you'll see managers take a slightly more cautious look, perhaps. Although, I think that everybody had last year when there was the dash for cash, that people would be very, very careful with their cash. But you've actually had 7-8 FTSE 100 companies announce share buybacks this year, which I find kind of interesting. Would suspect that maybe one or two people think that we are going completely back to normal. I hope that's right. But somebody who's not a big buybacks fan in the first place, I'm not necessarily a great sign.
So on that then, Russ, so we're looking at the economy. Obviously, we deal primarily with SMEs, typically maximum sort of £10 million turnover. But we're starting to see that thing. And the economy, I've been listening to quite a bit of them in America at the minute. And they've got there's a backdrop there where obviously they're into whatever Joe's signing up this week, 4 trillion, sorry, they're in for it. Yeah. We did a brilliant thing the other day on seconds. I don't know if you've seen that, about 1 million seconds, a billion seconds, a trillion seconds. Yeah. I'm going to put something on LinkedIn on it. It's amazing. So we get the context. Billions are yesterday's number, aren't they? Boris has thrown a billion there. We want a billion there, a couple of 100 billion there. So where do you see, in terms of the economy, what's your perception of the medium term in the economy? So we get back out of COVID, touch wood, we're all vaccinated up, that's great, and we get the drop down, the world catches up, hopefully. Where do you see the medium term of the economy? Just trying to give a backdrop, say, particularly for SMEs.
I think it's still pretty tricky because there's so much debt out there. I mean, hopefully, SMEs, have kept their books tight, and they've kept plenty of liquidity back. But I think that is a long-term challenge for everybody. Is that there is so much debt in the economy. Equally, you've got a lot of people who are doing very well, that asset rich. And so I think this concept of the K-shaped recovery is potentially going to be a feature for some time. The well-off are doing well, and those who are struggling are struggling. So I think the long-term growth prospects are difficult because population growth isn't great. Immigration is a bit of a hot button topic in the UK at the moment, and debt is a major problem, and that is inherently a challenge because at some stage the interest rate has to be paid. The interest has to be paid unless, of course, something's done about that. The Bank of England is clearly going to keep interest rates very low for as long as it possibly dare to help people fund those debts. And I suspect that the best way out, I mean, if you look at the debt that's accumulated, you either grow your way out of it. Well, let's hope so. I mean, you may well see a big bounce coming out of the lockdown, but after that, you'd expect that to normalise relatively quickly. Yeah. Then you have to try and pay it back. Oh, that's not going to really happen, is it? And so then you're either looking to inflate it away or effectively default on it. And we haven't defaulted on our debt since 1672, and we're not going to rush to do that. So you're effectively looking to inflate your way out of it. And I suspect that is the long-term game. I also think that we'll probably have greater government influence over the economy for some time because it's been dragged into it. But I mean, Boris Johnson is a libertarian, and he's been dragged into it whether he wanted or not.
Yeah.
But equally, if the public decide they didn't do as good a job as they should have done, they may decide to elect people who are more overtly in favour of state intervention. It's not something I'm personally in favour of myself. I think there's a balance between private enterprise and government. Government provides the regulatory protection, the education, the health that everybody needs. Private enterprise is then very, very good at making the most of that, and they need to appreciate that they have each other. But certainly anywhere where private enterprise is left to its own, it will clearly run amok and monopolise. And if the government gets involved, well, if that works, we'd all be speaking Russian, wouldn't we? So that clearly isn't a solution. Is going to either extreme. But the government is going to have to try and inflate its debt away. And that is something that investors are going to potentially have to protect themselves against. And it's easier if you're well off with assets than it is if you aren't well off without them. And I think that is, again, a societal challenge that we all need to be aware of going forward.
Two opinions I was listening. I got quite into listening to America, basically, which is because we will become very insular. It's good. I listen over the years, and I'm at advanced years. I'm trying to extend my view out of the UK. Right, we're in Northern Ireland, which is very parochial. We think the world's flat either side, sort of stuff, and that. But in terms of the Americans, there were two opinions, and there were guys I'd nearly respect. They're more business orientated. They're not necessarily economic experts such as yourself. But what they see is, when we get back, the businesses that were going to struggle in, and I think Luke Johnson used the phrase, in the business sense, if it had a pre-existing condition, you've had it.
Yeah.
Then they see a short-term stimulus. Obviously, there's quite a bit of pent-up cash in terms of, we're not being able to spend it, basically, apart from on our dear Amazon drivers. And then their concern is within 2 or 3 years, inflation. Whether that's too soon, but again, going back to age, and when I'm not trying to be wise on anything. Younger people have not experienced inflation. No one's experienced an uplift of any interest rate.
It's fascinating. I remember I was watching the original Ghostbusters with my kids over 14 and 12 now, but watching the original Ghostbusters over Christmas. And you may remember Bill Murray, who's the lead guy. He buys them the ambulance that they turn into the Ghostbusters mobile. Well, he remortgages his flat to buy that jalopy. And he says, I got a really good deal. I got 17.5%.
That day, I was talking to somebody the other day.
Telling that now to be look at you like you were from Mars.
Absolutely. But I remember the day. It's almost like the JFK thing, but about interest rates when it went to 18% that day, and Amanda Lamont. But if you got a great mortgage, and say you're paying 2-3% on your mortgage a month, whatever it is, your interest rate, suddenly 1% is a lot.
And I think this is why the foundations of the economy are not as strong as we would like, because interest rates don't have to go back to 5 or 6%, because as you say, there's so much more debt in the system.
Yeah,
the impact of an incremental point is enormous. Bank of America Merrill Lynch did a piece talking about, I think it's 1% on America's borrowing per annual deficit is the equivalent of NASA's budget, $30 billion.
Just massive.
We're talking huge numbers, and working your way out of them, it really isn't going to be very easy. So I share the SME's concern that we have some challenges. Now, inflation is the solution if you're a debtor.
Yeah, absolutely. But going back to your K recession, it's going to be the bottom part of the K.
It's going to be so cruel on them, because it clobbers them in terms of utility bills, food prices, and wages probably won't keep up. So it's not. There is no free lunch, but you've seen those statistics whereby was it a quarter of all of the world money ever printed has been printed in the last 12 to 18 months.
Yep.
You would logically assume at some stage that inflation will result from that, but it's not just volume of money, it's velocity that needs to pick up. And that's what you might get, because this time, whereas after the great financial crisis with quantitative easing, the government bought bonds, the money effectively went to the banks. The banks then didn't really do an awful lot with it necessarily. Whereas this time it's been stimmy checks and a lot of vitally needed furlough money, and that has gone straight to individuals.
Yeah.
So the ability to spend it straight away and the propensity to do so are both much greater. So that could have a big effect. And if we do get inflation, nobody's seen hide nor hair of it really, unless you're Venezuelan or Argentinian for 40 years.
Yeah.
So, and I think this is the danger of modern monetary theory. Got a lot of American economists and smart politicians saying, well, nobody remembers inflation, so who cares? It's never going to come back. It's like saying, well, a tree fell over in the forest, nobody was there, so it didn't fall over.
Yeah.
If anything, it means that the chances of it coming back are more, because people don't remember it and don't know the horrible damage that it did in the 1970s.
And it's
the UK went to the IMF on bended knee for a bailout, for goodness sake.
And it lingers for, not forever, but lingers for an age, doesn't it? And
it's a psychological, in many ways, it's a psychological phenomenon. It's like that old Yogi Berra quote, the New York Yankees baseball player. You know, he said that baseball is 90% mental and the other half is physical. We'll unstitch that in a minute. Yeah. But inflation is the same. It's 90% psychological. If you can start seeing prices going up,
absolutely,
then you think, hang on, if prices are going up really that quickly, I'm going to buy it today, not tomorrow, and I'm going to demand a pay rise. And that's when the whole thing suddenly starts to pick up. And yeah, it was a phenomenon of the 70s, but the damage it did to the economy in the 70s and to investors' portfolios in the 70s, from a different perspective, was huge. In the 70s, the only things that really worked cash was a nightmare, government bonds were a nightmare. The FTSE All Share actually doubled when Dennis Healey was Chancellor of the Exchequer and Harold Wilson and Jim Callaghan were Prime Minister 74 to 79. But inflation, the retail price index rose by 110% over the same time period. So you were no better. You just about washed your face. That wasn't bad.
Yeah.
The things that did well were commodities and real stuff. So gold, silver, and the only equities that really helped you were anything that you could pour down your nose or down your throat or the sink, i.e. consumer staples, because they have pricing power because people have to get them.
Yeah.
So they were able to move their prices up and cope with the raw materials. But from your SME's perspective, when in the mid 70s interest rates were 18, 20%, who on earth is going to build a plant?
Absolutely.
When money's going to cost you 18 to 20%, and you can get an 18 to 20% guaranteed return just by leaving it in the bank. That's the damage that it does, and people mustn't forget. Just because we haven't had it for a long time doesn't mean it can't happen. Once you flip that switch and the psychology changes, it's really, really hard to flip it back, as Paul Volcker and Nigel Lawson proved in the early 1980s.
And it's also very difficult today as well because of the complex mix. It's again back to the SME world for a minute. Is the complex nature of finance at the minute when you've got the peer-to-peer platforms. Generally, the high street big four as was sit back a lot of them. They're fairly cherry picking. And we sometimes see this talk. We had one guy came to us and he had 23 of these bloody platform loans, and it's trying to unravel that sort of stuff and the effect that's going to have. Again, I don't want to be prophet do, but it's trying to get that balance and just say, right, this could happen. And like we said, a little Suez event, not that big one event, but heaven forbid, any other form of illness, pandemic, whatever you want to call it. We're pretty fickle, aren't we, as an economy?
Yeah. We are. It's again, the foundations are not as strong as you would like, and that's the point about your SME there with umpty tumpty different loans. If you read William Shawcross's book on Rupert Murdoch, again, go back into the depths of time in 1990, 1991, News Corporation was nearly going bust because it was shoveling all this money into this funny satellite broadcasting company that nobody had ever heard of that was losing bundles. There was a recession on, so print advertising was under pressure, so there was a double whammy. And I think News Corp had to roll over debts with about 160 different banks.
Yeah.
One, I think it was in Pittsburgh, went no. And at that point, News Corporation looked like it was going bust. And I remember that distinctly because I was just starting my career as a fund manager. And the very bright lad who ran the Aussie desk was up the kazoo with News Corporation stock. He had it up to here because he was convinced that people wouldn't allow, they just, if you pull the rug, you're going to take a massive bath here. Yeah. So, you're going to roll over, and eventually they did roll over, and News Corp stock went absolutely ballistic, and then didn't look back probably until the phone tapping scandal. But it shows that it can be complicated. And unfortunately, in the case of an SME, a bank probably would be tempted to pull the rug because the damage wouldn't be as great as it would be pulling the rug from underneath nice Mr. Murdoch. So I think that, and also what you tend to see during the number of you tend to see unemployment go up and corporate figures go up when we come out of a recession, because that's when companies need more working capital to fund, inventory and stock and trade receivables and buy plant. And it's also when the banks think, oh, we've survived that, we can actually get something back now if we, So it coming out of the recession can be a tricky time for SMEs. Yes.
Yeah, very much so. Because it's again that availability of funds. Again, back to John Goodfellow was talking about once, again, because he was at the time, and I can speak because he passed away a couple of years with some of the stuff he said, but he was saying that with the 2008 crash, For instance, I think Lloyd's have been kindly passed on Halifax. There you go. You can have Halifax. So there's a good one for you. Don't thank me. Okay, so you got that. But he said, you imagine that man's to-do list. I can't remember who was the CEO of Lloyd's then, but the to-do list on a Monday was must find £11 billion. But I've got a feeling that we're slightly going to get into that place, possibly where the very fact you need to borrow money would preclude you from actually being able to get it, because the rate's going to be there. So it's almost like self-fulfilling. You go, right, okay, he's going back to the rates you were talking, say it's 12%, right? Yeah, I'll have it. Well, why do you want it at 12%? That's crazy. It's almost like, so it's just
a way to get to.
Absolutely. Back on the macro side, if you can, because but on this side here, government borrowings. So the Americans are in for 4 trillion and 1.9 this week. Rishi must be in for, I don't know, whatever it is, 700 billion, 500 billion, whatever the figure is. How long can they carry on doing that?
It's a brilliant question. So long as they keep paying the interest, in theory, the one argument is, well, they can keep on doing it forever, right? But I think, it gets harder and harder if and when, government bond yields are trickling up already. If interest rates start going up properly, then it gets really difficult. So then what you end up doing is probably printing more money to fund it. And that takes us back to the inflation question. It's a matter of psychology and confidence amongst those people who've lent us the money.
Yeah.
What interest rate they're prepared to accept in return for the risk of inflation or the negligible risk of default. So what I suspect is that the long-term solution will be a combination of, there'll be money printing, but it's also what Carmen Reinhart called financial repression. And she developed that concept from some professors in the US in the 70s whose names I've forgotten. So I apologize if I'm giving credit to Carmen Reinhart for all of their work, but she certainly developed it. And she said that, and this was based on how banana republics dealt with their debt crises in the 60s and 70s. Mm-hmm. So basically the first one was, you crush interest rates to zero. Tick. Secondly, central banks then start manipulating bond yields to keep interest rates low. Mm-hmm. Third, the government then starts leaning on the banks, telling them, well, actually, we really think you should be lending here. And if you think that's not happening in the UK right now, C-bills, CL bills, the trade-back, the government guaranteed loans to the mortgage market, the government guaranteed loans to EasyJet and British Airways. Yeah. Tick. It's happening already. And then what you have to, then we'll be looking for some inflation. And then then you move on to actually, I'll tell you what, we're having to issue so many of these government bonds to fund our debt. The next step we get in financial repression is banks, insurers, financial intermediaries, as part of your capital adequacy requirements, you have to own these things. Yeah. Suck it up. Yeah. That's the next step. And the last step is when people think, Christ, they're coming for everything. That's when capital controls come in, so to stop money leaving the country. Mm-hmm. And that's the fifth. Now, hopefully, people forget it was only Mrs. Thatcher who got rid of those in the 1970s and 80s. You used to have to, take about 50 quid worth of foreign currency with you and a lot of travelers' checks. So people forget these things. So that's your 5-step checklist, as it were. We're already at number 3. Mm-hmm. Mm-hmm. We're ticking them off, aren't we? As you say there. I know it was all based on banana republics, but our debt's not too dissimilar from banana republics in the 60s and 70s on a percentage of GDP basis. And it's how quickly governments do turn on the financial institutions, like you say. We do a bit in Spain. Bogeyman, always look for a scapegoat. When we had the 2000s, so we're dealing quite a bit with people that bought negative or have negative equity on property that they bought back in 2008. We always say they got off the plane full of sangria and signed up and made a mistake. That's cool. Then you've got the banks. We've worked with the banks right way through there, and now they're turning back on them. So then they said, right, we'll cover basically any losses. Don't worry, just keep writing the checks. That's cool. Now they're flipping it back to you saying about retaining the assets. Make sure you got the assets. They're saying if you've got the shortfall there, if there's 100 grand on a property and you've got 1,000 properties, we want that money lodging with us physically. And so then that pulls the banks back in and tightens them up. And then you've got our economy, all economies are fragile. Spanish, we know the Italians and everything else there, but it's just very, very subtle things that can quickly turn. Right, that's all pretty negative we've gone through there, right? So, but it's something we need to know the backdrop. Something we need to be aware of. Absolutely. The debt is a problem, and it's not going away in a hurry. Inflating it away is probably the best of a very bad list of options, given where we are right now.
So if we look in, obviously we're starting to get inquiries already because we deal with, as soon as business start to come under pressure, then they start to come to us, and it doesn't sort of fill me with joy to say it, but we're going to be very busy going forward. Yeah, commercially very good, but you still don't want people to struggle. But we're already seeing, just as we start to open up again, people starting to lift the phone, we're starting to see a few lenders tightening up, a couple of these platforms tightening up, a couple of the developer style platforms just hang on a minute, guys, let's just count every bloody brick here, not measure it by yards and all this sort of stuff. So you're starting to see that. So we're in that side. So the good side is there's been some real successes, in lockdowns, and some of our clients a lot. It's hardly changed. It seems to be the traditional retail, the obviously hospitality devastated, construction. There was is it David Smith that writes in the Times? He always does his skip count.
Yep.
That's his basic economic
or crane count. I used to do a crane count whenever I went to Manchester. Yeah.
Oh, cheap as Manchester. They'll have a crane in Manchester, don't they? So, so there's been the good side, and there's going to be the fallout through it. But it's almost like not to not worry about what's here in the, say, next 18 months, 2 years. It's a bit further down the track that I think there's going to be a sea change in attitudes and everything, and our ability to do it, not just financially. We're going back to our younger people, their ability mentally to deal with bad news or things going wrong.
I think it was Herbert Hoover who said, blessed are our grandchildren, for they shall inherit the national debt. And that's a major issue going forward. I know that inequality is a major issue. That there is a solution. How long are we from a millennial prime minister or Chancellor of the Exchequer? Not long.
No.
10 years, 20?
No.
All right, certainly a Gen Z anyway. So just demographics, in the end, you will have people from those generations who feel that they're not being given a fair lick of the bottle.
Absolutely.
They're going to be in charge. And then they're going to say, well, all this lovely housing stock that you beggars have got, we're going to tax the pants off you. So that there can be things that will change, but it's going to be a generational thing as demographics does its thing.
Absolutely, but there's a two sides to it. They're going back to what you were saying about the K-shaped recession. As I see at the bottom part of that, is going to be younger people. They are going to be, not to generalise, but the baristas of the world and bar guys and girls and stuff like that.
Eventually, they're going to be running the country in a different way, and
massively.
And they may well choose to settle a few bills in various ways, shapes, and form, which is something of which people with assets. They need to be aware of that from a financial planning perspective, shall we say? Absolutely,
in every sense, and that going back to that mix, and going back to your footsie fund through to back to your aim punt sort of thing, isn't it? It's just keeping that right mix there.
Correct.
Because we're talking. If you look at Macron essentially got voted. He don't judge the man now, but in terms of where he came from in terms of politically to come to where he was, I'm old in the tooth. I am sick to death of politicians and their inability to sort of nearly answer something. And they just, I think they're missing out. Going back to your thing on the generational side, I don't think they link at all with them. I don't think they link at all.
I think some plain speaking and some truth telling, painful as it is no bad thing, personally.
Absolutely.
And, because in the end, Gen Z and the millennials, they aren't daft. They're going to work it out for themselves. They're working it out for themselves anyway. They feel that they're getting the short end of it. And at some stage they will be in a position to do something about it. And I would much rather, frankly, pay an extra few p in the pound in tax if the alternative is having to be beating my front door down.
Absolutely.
It doesn't take a lot. Only in my darkest hours do I think in those terms. But ultimately, you can see it in Brighton sometimes. Certainly during the winter lockdown, from hopefully which were just emerging, you could definitely see people who economically are on the edge and are really struggling, and it's not a nice thing to see.
No, in today's world that shouldn't be, should it?
You'd like to think not. No, I mean there are some people who've made choices that have taken them down a bad path, particularly here in Brighton. But there are a lot of people out there who are grafting away and not necessarily feeling they're getting a fair lick at it, which is not good.
Mm-hmm. AJ Bell, and this isn't a selling thing, but they do quite a bit for disadvantaged young people, don't they?
Yeah, and I mean Andy Bell is our CEO, and I know I'm being recorded, but he is an absolutely fantastic fella, and he's acutely aware of the company's responsibilities, not just to its customers, but more widely. We didn't accept any VAT relief, any rates relief. We paid all of our tax. We didn't lay anybody off. Mm-hmm. And he's run several charitable initiatives during the pandemic. So we were giving free tablets to care homes so people could see their relatives when they weren't allowed in. And we've been running various food bank and food share schemes as well. So it's something that everybody at the firm is encouraged to chip in. So I actually spend Mondays, Monday lunchtimes doing food bank deliveries myself. So here in Brighton, believe it or not. So coming back to the desk, then talk about Deliveroo has been quite an interesting, juxtaposition of dealing with people who need food banks to the guy Will Shu who runs Deliveroo, saying, well, in the future, it's our mission to, there are 21 meals a week, and on average, households get one online a week. And it's my mission to make sure it's 21. I thought, no, I'm not buying into that.
No. Mickey Clark about Deliveroo. I'd see unfortunately, their shares have slipped a fair bit this morning, I think. Haven't they?
That's one way of putting it. Yeah,
that's
a bit of indigestion there, I think.
Yeah, absolutely. But when you start seeing them hanging outside Greg's and doing deliveries from Greg's and something like that, you're suddenly sort of down product-wise anyway where you are. But Mickey Clark always said about Deliveroo, hang on a minute, middle-aged men in Lycra on bikes with a blue box on the back and a fancy bit of software, a unicorn.
I was intrigued as to how the valuation was 3 billion in November, 5 billion in January, and 8 billion by March. Anyway, that kind of struck me as being.
But I think it's part of where the cash is in the world, isn't it? So there was I've forgotten their name. Is it Mesky or Besky, the guy at Airbnb?
Yep.
Because obviously they fell off the side of a cliff when COVID came. Then suddenly they're valued at 120 billion. It's gone crazy. They were literally running around grabbing cash but the cash is in the system.
Well, the cash is
in the wrong place. In the wrong place.
This is one of the dangers of, again, it's central banks. They get a lot of credit. They get a lot of flack. They're probably being given too much to do, or they're taking on too much to do. But one of the unintended consequences of holding interest rates at zero is that, well, if there's no cost to owning it, people disrespect it.
Absolutely.
And therefore you are seeing, the danger is that you see capital misallocation. And I'm not getting at the people who got involved in the GameStop thing, because they felt either there was money to be made, fine, or there was a principle to be made.
Absolutely.
Fine. It's their money, right? But and again, I'm not their dad, but the fact that there was some people saying, well, I bought these shares just to make a point and stick it up their hedge funds. I mean, if you've got enough money lying around to run the risk of losing money just to make a point. 13 years ago, people were standing outside Northern Rock wondering where their money was.
Yeah.
So I think the fact that we've come that far in just 13 years, to me, tells us how over liquefied the economy is and how QE is breeding the grounds for capital misallocation. And that's when serious accidents happen, as we found out when the tech bubble burst in 2000 and the housing bubble burst in 2007. But bull markets end when the money runs out, and the money runs out because it's put somewhere at the wrong price, at the wrong time, or to the wrong person, or all three. And that's when you get trouble, whether it's tulip bulbs, Japanese property, Latin American mines, or who knows, food delivery companies. Will find out.
But you're right, because of what you're saying there about the government. They can't do right, or any of the authorities can't do right. You've got Bibbles and Sibbles, absolutely vital. Now we're already starting to worry about. I think it was a survey in the Financial Times. They said 42% of the Bibbles borrowers didn't intend to pay it back. Not they couldn't, didn't intend. Yeah. And it's a bit but the system still needed the cash. So whatever the figure, I think it's about 73
It was a no-win situation. I suspect that they're probably taking the view that, and then don't forget those bad loans. I think the banks will be swallowing some of that at least, not just the government. Which again comes back to the financial repression tick list from Carmen Reinhardt. But yeah, it was an invidious choice. But again, it would have been an easy choice had we not started with the debts that we had, and that comes back to the system, the foundations are becoming progressively weaker because the borrowing that everything's based on.
Mm-hmm. It's a difficult backdrop. But we still, I think we're still a brilliant country, as are America, as in most around.
I wouldn't want to be seen to be doing Britain down at all. And you can look at companies like IP Group, which is it's based in Sheffield, so I'm slightly bigging it up, but not that that's my hometown. But Oxford Nanopore is talking about floating at some stage this year. That's been right in the vanguard of the fight against COVID. It's a leader in DNA and RNA sequencing. And Alan Albury, the guy who runs up IP Group, is always never gets bored of saying, Cambridge University has got more Nobel Prizes for science than the whole of France.
Yeah.
So I really wouldn't want to be seen to be doing the UK down at all. No, because it's got phenomenal things going for it. It's got language, it's got culture, it's got, from a financial market perspective, it's got a great ecosystem, it's got a great position in the world. It's got rule of law. It's got an independent central bank. It's got a floating currency. It's got lots of things going for it from a purely financial perspective. And yeah, I do not want to be seen to be doing it down. Like any major developed economy, it faces some challenges which need to be addressed, which are not easy to address, particularly by people who think in 5-year cycles through their seat, if you pardon the expression.
Yeah, absolutely. But what I've noticed as well, on the upside, is young entrepreneurs, especially during this period, have been very good. I was doing some work. I was on a course with Tony Robbins, which is he's a bit of a rah-rah man in America, but he's very, very good in what he does. And what he's saying is we need good, strong young people who know what they're doing, because there's going to be quite a big, not quite a big, a big transference of assets in business terms when you look at the baby boomers coming to the end of their cycle, and gentlemen of my age particularly. But it's that not a lot of places for them to go either. And then but I think we've got a very sharp, we've got quite a few clients here in Belfast, not necessarily clients because we deal on the wrong end of the food chain, where you're seeing some guys who really are pushing it here, pushing.
And one of the things I try and do to give back is, as it were, is to help out the Age of Bell apprenticeship program, and the quality of the kids that come through there.
Yeah.
I wouldn't get a job going up against them. I wouldn't have got a job going up against them. I can absolutely guarantee you that. So I think that is fantastically encouraging for the future. Yes.
And there's a young guy here who's got a great business. I won't mention him because sometimes they get tarred because they're associated to us because we definitely do problems. But he's not. It's literally a man I bump into a coffee shop, and I know a relative of his. And the work ethic, I think if young entrepreneurs do get that work ethic, once they get rid of this rubbish and the private jets and fake it till you make it, all that rubbish, get all that garbage out of the way, there's some brilliant businessmen and women. And I think through this recessions we face, the strength of good people are there. If we can get rid of this rubbish that's and with that backdrop of the transference, and you get that environment, I think once you get through this period and get it settled, and wherever the £1 trillion lands, be it a bit like a war bond, 70 years this bill's going to be picked up. Cool, that's down the track. But I think there's a good side here. It's a real good side. We've still got a massive thing to do with our high streets. It was a great thing. I don't know if you saw it, the Ipswich initiative recently.
Oh, yeah.
Where they're looking, so you go to the centre of the town and look out for 15 minutes. So usually you're travelling into the town, because central towns are just obviously dying and dying and dying. So everything needs to be 15 minutes away. So if you live there, is there a school 15 minutes away? Is the train station?
Okay, yeah.
And it's quite, and you're trying to, because we've got to do something. There's only so much bloody coffee we can drink, so many charity shops we can go to. So it's just they're trying to change it in that sense, which is quite interesting. And we need this new stuff here. There's a lot of good urban stuff still going on. I know on the urban side, you're mainly Manchester based as a company.
Salford Quays actually, so you can see Old Trafford cricket ground out of one window and Old Trafford football ground out the other, if that's your thing. There's a London office that's sort of 80 to 100 people just near Borough Market and Blackfriars railway stations. So they're in Salford Quays the Salford Quays office is in a very up and coming bit of Manchester. Salford is very dynamic. It's growing like absolute fury as is much of Manchester. So I guess AJ was doing its little bit there. Yeah, and more people as well now that World Service Radio's business department's moving up there as well. And generally I would, as a stock market investor, indeed as a person, I would not want to bet against human ingenuity over the long term.
Absolutely not.
No, that's not a good bet to take on, in my opinion.
No, and I say we're stronger than the dear old mainstream media would have us believe.
I would think that. Yeah, I think I would not want to bet against our finding a way around. So there will be some nasty things like inflation, and also companies like Deliveroo, whether it's a success on the stock market or not, the technology is there, and I'm sure there will be entrepreneurs thinking of equally amazing platforms, equally amazing and not more amazing things.
Yeah, some of the stuff that's coming out is brilliant, really good. Just one thing before we go on, we're going to do a quick fire round here.
Okay. What is the capital of
one thing? You've been brilliant on names, right? And I made an absolute cock up of the first bit there. The landlord beer I said was Maradona's favourite beer. It's Madonna.
That's why I was looking even there. Actually, I think
you didn't know that. But Madonna, you Google and check that. But Maradona. But
one of the first dates I had with my wife was at a Madonna concert, actually.
So you're going to say Madonna then? But
yeah.
Cool. Just a quick then, a little bit of fun, right? So, wine, red or white?
Depends on the mood, but I would say white. Just
there you go to, yeah.
Yeah,
Good.
if given a choice, I'd drink. I would, and I could afford it. I'd drink a Conduit.
Oh, very good, very good. Sport other than football and horse racing. Give me two.
Cricket.
Cricket, good man. And Yorkshire.
Yeah, though I live in Sussex, and I do actually help run the boys coaching at our local club here in Brighton.
Very good, very good. 4 dinner party, fairy godmother. I'm cooking. You're there. 4 other guests. It could be dead or alive.
I absolutely adore. I do adore horse racing, so I would go for people in horse racing who don't talk publicly.
Yes.
So it'd be Sheikh Mohammed, His Highness the Aga Khan, Sir Michael Stout, and Andre Fabre, because they just never say anything in public, and they are absolute masters of what I know. Sheikh Mohammed's got some public relations issues at the moment, which I accept need to be treated with, need to be treated with caution in many different ways. And there wouldn't be a lot of alcohol consumed at that dinner, but it would still be fascinating all the same.
In the kitchen, we'll keep the one in the kitchen. Then the other one, I tell you, who's very good as well on that set. So on Twitter, Fergal O'Brien. Did you ever catch him?
Yes. Yeah.
Funny man. Very, very self-effacing in that sense, but that's a different thing. Favorite social media platform?
That's a tricky
platforms. They'll give you a bit of latitude there. So
yeah, I don't tend to use. I do tweet about beer and football and things. I'll go for Twitter, but I'm a sparing user.
Yeah, but what would you like? What would you do? What interests you? What sort of catches your eye? And you'd sit there and scroll for a while if need be.
I tend to follow the football teams and the horses is really what I look for, and then tips on. And anybody's got an interesting beer, then I tend to have a look for that.
Right, very good.
And there are a few stock market bloggers I follow who are very, very interesting as well.
Very good. And last question, and we're putting it back on you, right? We need. So you were kindly suggested to us by David Buick, the City Grandee, if you're watching. So could you give us 2 people you think we should talk to in terms of this context? Hopefully, it's a bit of a rambling carry on what we do here, but it gives the context. What we're trying to do is find our way through all the BS, as I said at the beginning. Yeah,
Michael Hewson at CMC Markets is tremendous.
Right.
He's a very smart guy. His dailies are excellent. And I think if you want a slightly different angle, he's more of a currencies man, but therefore he's got the top down all sorted out. Is Richard Perry of Hantec FX.
Very good. And we can mention your name?
You may.
Very good. No, don't mention my name.
No name's no drill.
Absolutely. Brilliant. Thanks for that, Russ. That was a
pleasure. It's great
fairly
fun.
Whistled through. Just a bit of a crack, wasn't it? It's almost like a cup of tea there. And if it was after 12, maybe taking a fancy craft ale, one of your cloudy craft ales there.
No, later. Friday. I try Sunday to Thursday. I try and
school nights.
Yeah.
Very good. Thank you. And thanks again for your time. That's brilliant.
Thank you. It's been a pleasure. Take care. Keep well.
Look after it. Speak to you soon. Thanks. Bye, Russ. All the best.